Good evening. Good to see so many people today. And so I will present International Biotechnology Trust. It's a trust that's been around for 30 years. So we have a 30-year celebration this year. So keep outlook. And as you can see, the 30-year celebration mark. My colleague Elsa Craig is not here today, but our background and investing in biotech is probably a prerequisite to have scientific background, which we both have. Elsa has worked 20 years in the industry, in the finance industry, whereas I have done 20 years, where the first 15 years I did within the pharma industry, developing drugs, selling and buying projects and companies within the industry, which is the mainstay what nowadays is drug development. And I will come back to that, but just an anecdotal fact is that 70% of all drugs approved last year emanated from biotech and not pharma, as many years have been. 10 years ago was the direct opposite. So performance and strategy, I will come back to that, but we focus on the innovative side of drug development, meaning that we do not focus on late stage products for statins, etc. We focus on pure innovation that hopefully will cure or address very high medical need. We have a really good performance. We have beaten the index on 1, 3, 5, and 10 years, so we have a really good performance. We try to lower our volatility. Inherently, biotech is considered relatively risky because clinical trials have an inherent risk of failing. We pay a yield, 4% on NAV every year. It doesn't come from dividends per se. I will come back to how we think about that. And we have Schröder's offer a good expertise because we have a venture part within the Schröder's family, but also we have a pharma experts within. So we collaborate quite extensively around that as well. So looking at this is a slide I need to show because according to compliance, but I gladly do that because you can see that over the years we have performed very well according to the index. And usually pharma have approximately 5% annual growth rate in pharmaceutical spend. With that, you have patent expiries, which is approximately 5% as well. So top line growth of new drugs is approximately 10% per year. That's the fundamental growth in the industry. So how do IBT differ from other biotech trusts or other ways of how others invest? To begin with, we focus on a top-down and bottom-up approach. Might sound like, yeah, well, that's what everyone else does. But we put a lot of effort into focusing on macro. The previous speaker talked about the geopolitical risks, which we absolutely take into consideration. US is, for example, 40% of the global pharmaceutical market and probably 60 to 70% of profits. So having not that into consideration would be foolish. We think about the macro environment. Biotech is very tightly correlated with interest rates, and I will come back to that. We tend to reduce our positions going into binary events. What does that mean? When we have a big clinical trial for a company, what is inherent in this industry? If it fails, the company will lose almost all its money and value. So we tend to take down our risk exposure to these companies because we don't believe we can second guess a clinical trial outcome. It's usually priced in. We tend to wait, reduce our position, evaluate the data very quickly after it arrives, and then take a very quick decision if we're going to continue to invest or not. And that lowers our volatility and cash preserve because that's how we think we can win long term. M&A is a big feature in the industry. Pharma basically buys biotech companies and develop their drugs. That's basically how the industry works nowadays. We use gearing tactically when we feel there is an opportunity. We gear our portfolio and do the vice versa. And recently, we have also introduced a theme basket, which means that if we believe an area, specific therapeutic area is of high interest, we don't believe we can pick a specific winner when we are early on in development because safety shit can occur, different outcomes, positive or negative, can occur. So we tend to be guarded around 5 to 10 companies with a specific therapeutic area. And obesity is, for example, one of these areas. I will come back to that later. Probably you have questions about that. And also recently we have reduced our exposure to oncology. I will come back to that reason as well. But a lot of investments have gone in there. So return on investment has dwindled the last couple of years. So how does biotech work? This is with me. I've been doing this for 20 years, and I've gone through several cycles of boom and busts. I started after a bust. This is maybe why I'm conservative when it comes to investment in biotechs. I've gone through the 2001 boom, but also worked during the bust. So what happens is that at stage one, we have despair. Nobody wants to look at biotech. It's considered very complicated, complex. Nobody wants to invest in that. And this is the time where we actually like it. It's painful to see because we have, it's investing in companies that have low valuations and nobody wants to touch it. But that's actually a good time to invest because eventually this has shown over and over again, this cycle recurs. You have a stage 2 recovery. What happens is that usually pharma sees the opportunity to buy these cheap biotech companies, many of them valued below the cash they have in the bank. And once that happens, you see people coming into the market. And then we have an equilibrium stage with fair value. You have IPOs coming in and companies taken out. And then we have stage 4 euphoria, which probably during the pandemic, we have a euphoric stage when biotech went through the roof and consequently crashed. But we believe we are in stage 3, approximately at equilibrium. The IPO market, the public, new public companies, very few and far between, which means the spigots have not opened yet, which we feel is good because we need to consolidate. We have a lot of IPOs during pandemic, which now have consolidated and productivity is on the rise. And this is one way of showing that we believe valuations have bottomed out, or at least we feel they are attractive. This is a 5-year graph of performance of Nasdaq Biotech Index, which is the benchmark we use, which is the blue line, and S&P Biotech, which is equivalent of the smaller biotech names. As you can see, during the pandemic, we went 150% up in biotech within 9 months. And I actually, together with us, took over here, which is the worst time you can only lose. So the first thing we did, we wrote a blog, which you can go into our homepage and see. We write a blog on a monthly basis. So we believe some pockets of the industry are overvalued, obviously. But as a fund manager, advising people not to invest is not the best strategy. But I felt this is not justifiable. And surely we just saw the very quick correction valuations. And then on top of that, we had increased inflation and thus the interest rates that hammered the rest of the industry. And as you can see, we have been 6 years down the line, we have barely moved. So we have been bottoming out for 6 years, whereas the S&P 500 continued moving up. So we have seen valuations, we believe, are on our side. On the right-hand side, you can see companies, a proportion of companies valued below the cash they have in the bank, meaning a company is worth 500 million might have 1 billion in cash and still be. So this is a good tell sign. I've never seen anything like it in my life. I did see something like that during the boom bust in 2002 and during the great financial crisis. As you can see, around 20% of companies are valued below the cash in the bank. Sure, many of them of poor quality, I admit that. They maybe should be valued below cash, but it's a good tell sign showing that the industry as such is in a shape that we believe is ripe for recovery. So how do we think about the top-down and bottom-up approach? To begin with, we think about the market cap. We need to have companies that are big enough. Biotech is much more evolved now than it was 20 years ago. majority of the companies, or the biggest ones, the Amgens, the Regeneron, much bigger than AstraZeneca and Glaxo, and they pay a lot of dividends. Maybe not a lot, but at least they pay dividend, and should be treated almost like utility-like safe havens. So we try to have that as an anchor in our portfolio, and then we follow up with the more growthy name, as you might say, and then of course on the top up with the potential new breakthrough companies that might change the whole treatment landscape. So that's one way of seeing it. And macro environment is very, very important, and therapeutic areas. The key is to spread the risk as much as possible. When it comes to company-specific ways of thinking how we value, is that we prefer the company owns their own asset. It sounds very clear, but sometimes they share the asset, or they have licensed out the rights to it, which means the value of the company probably is lower and the upside is limited. Of course, they need to address an unmet medical need. Otherwise, it's impossible to actually charge the price you would love to do or want to charge. So this is one of the areas we focus on, that you need to really address a very high unmet medical need. If you do, you probably will have a monopoly position per definition. The companies should have financial strength and pricing power, meaning that they need to preferably have 18 to 24 months of runway in the bank, because we don't want to continuously support this company with new share issues, because that's not what the company should be focusing. They should be focusing on delivering clinical results. So this is how we think about it, and these kind of items I brought with me from the industry. This is how we looked at companies when we in-licensed them. So coming back to M&A, which is a big feature in the industry. I have a kind of M&A background in the industry. So during our tenure here, we have 27 M&A deals during the last 5 years, meaning it's approximately 4 or 5 per year. And what happens, and these are the premiums, and as you can see, between 40 and 100%. This is what companies pay premium. And this is one way we see the dividends pay out to our investors. Normally we get, for example, the latest was Intracellular, which was acquired 2 months ago, and that provided us dividends for 3 years. Approximately 10 to 12% cash coming in through that acquisition. So this is how we view the dividend policy at IBT. So why do pharma need to in-license new stuff? One of the items is that patent expiries, as you can see on this slide, will be increasing over the coming years. Pharma has not been able to replenish their own pipelines. They just have a drought. And it becomes more and more urgent for them to fill the pipelines. They are really good at executing complex, big trials, getting reimbursement, but they are not good at innovation. So the division of labor have really been exacerbated over the last 10 years. So biotech is the major innovation hub and drive the new drugs. Our portfolio, as I mentioned, rare diseases is our main investment focus at the moment, 22%. So what are rare diseases? Usually a disease that obviously is rare, but the key with that is the governments and reimbursement authorities tend to prioritize companies often affecting kids, addressing very high unmet medical needs, and pricing is very, very stable, and we believe you can actually make a lot of money out of that, but also add to you have a societal impact. Oncology is still a big portion. Majority in the world investments are in oncology, but we believe currently we have a lot of crowding, a lot of companies following the same diseases, which means that you have 5-10 companies fighting about one disease, meaning that there are very little to everyone to share. And then CNS, which is central nervous system. During the pandemic, it became clear that that is a big challenge for societal challenge, major depression, bipolar disorders, but also Alzheimer's, which is a demographic thing that comes in Parkinson, and the rest follows. One item I would like to point out is that biotech might, with UK eyes, be considered you're sitting in the lab and in the microscope, etc. But the reality is that 50% of our companies have already, that we are invested in, already have a drug on the market. They're very, very different from what you might view like a biotech company, like five people working with a lab coat. It doesn't work like that anymore. These companies have thousands of employees often. Half of them, what is considered early stage, is very, very, very seldom we have a drug that doesn't have at least phase 2 clinical trials conducted, which means they're relatively late in their development. Coming back to the basket approach we did, we have a central nervous basket of companies that we focus on. We believe once there is an interest, if one company gets acquired, it lifts all the boats. Emerging oncology, there are certain pockets in that space that we believe are very interesting. M&A targets, which kind of shake it out itself. When you have companies that have specific characteristics, they end up there. And the latest addition, I would say, is obesity. We don't look at the kind of GLP-1s that everyone was talking about, Ozempic, Wegovy. What we focus on are the next generation obesity drugs. So what are the current problems or challenges we have? Tolerability is pretty poor. People get GI tract problems. You have to inject them. And a big issue is that you have a lot of muscle wasting when you lose weight. So we are focused on companies that can have a better tolerable drugs. Some of the companies try to preserve muscle mass. It's a big problem, especially when the elderly, it's hard to build muscle back. So this is how we think about it, the next generation drugs. Our top 10, many of the names maybe you will not recognize, but I would point you to this stage when we can say some of them profitable, phase 3. Every one of these have clinical trials conducted with successful outcomes. So these companies will or are in the process of getting their drugs approved. Very attractive for pharma companies to acquire because they can slot them in their machinery. And in fairness, biotech, according to my opinion, should not be doing the marketing because it's very costly and pharma is actually really good at it. So sector outlook. We have a demographic shift in the world, and I think it works well for biotech because the population above the age of 65 will go up with 200% over the coming generations. And why is that good for biotech? What has been the historical, is that heart disease starts to occur at the age of 50 and then increases. What has happened in the world is that we are much better at treating heart diseases. The consequence of that is that more people live longer to actually get cancer. What's great about this, which is a kind of sad slide in a way, but cynical slide, is that 70%, the latest stats, 70% of people that get diagnosed with cancer actually survive that, or at least die from something else, which is good statistics, I would say. And the next frontier will probably be Alzheimer's disease, which we are starting to address. So we are going there. The innovation is going exponentially. This is a number of drugs approved by the FDA, the US authorities, which is the most relevant and most reliable in terms of approvals. And you can see there's a continuous rise. And a proportion that comes from biotech, as I mentioned, is 70% in 2024. No presentation without these two guys. And I guess that questions will come out. But we believe last time Trump was president, biotech went up 40%. We don't believe he will impact biotech. He will impact macro environment and many other things. But biotech, we think, will be less affected. One thing that he has promised is that FTC, the Commission for Mergers and Acquisition, was very, very tough during the Biden administration. And he has promised that he will take that away, so mergers will happen. And since biotech is very, very dependent on that, that's the positive. The negative, yeah, RFK, he might have opinions about how drugs are approved, etc. But on balance, we believe it should be neutral, whatever that means in a relative perspective. So I think I've finished there, and questions welcome.
Marek, thank you very much indeed. Thank you. Terrific. Okay, do you want to get in there? Have you any questions for Marek, please? Raise your hand and we'll come over with the microphone. Otherwise, I've got one or two to kick us off. No? You mentioned most of the companies in the portfolio are reasonably mature and maybe more mature than the stereotypical traditional image of biotech as you described. So how small do you go? What's the smallest market cap that's investable for you?
So it's a really good question. I mean, we don't discriminate, but I mean, you can see, you can see Calvista here is like 300 million in market cap. It's very, very seldom you have that, but what tends to be is like the more the risk they are in terms of risk of failure or whatever you might say, the higher we can go. But there is also importance that you can come in and out of the share, which means that we very seldom we have more than like 2% in a company like that. But as you can see, like Regeneron, a $60 billion company, you can sell within a day if you want to. But normally, if you think about the Nasdaq Biotech Index, I think the median valuation is probably around $1 billion. I mean, think about it, $1 billion, it's not small, but that's kind of the median company.
And the other main question I had was interest rates. You described how there's a correlation between interest rates and biotech performance as a sector. Could you describe why that is the case and then the outlook that you have for interest rates and what that might do to the sector?
It's a really good question. When you think about it, I usually tend to say that you should focus on the 10-year yield. Because once you discover something, it probably takes around 10 years to develop a drug, which is kind of a good proxy for the 10-year yield. So you have all the costs coming your way the coming 10 years, then you have the revenues. And you can just do the calculations that the higher the interest rate, the more you pay, and the future profits diminish with high interest rates. And this is the reason why one of the reasons biotech have had a hard time during this interest rates hikes. It peaked 2023 in October. Then we decided this is the peak in the long run. The key is not the interest rate, but the kind of trajectory of the interest rate. We thought it peaked in terms of going upwards. So we started to invest in the smaller names, which have more prospects of growth. So that's how we view it.
And so can you see a direct correlation when rates start to come down that has a direct positive impact on valuations?
Absolutely. I have a slide here that I've not shown, but I thought that would be maybe too complex. But you can very easily see in specifically when you have quick hikes, when during the last couple of weeks, when interest rates went up during the Trump's tariffs, you could see that the biotech index suffered. But that's kind of the name of the game, unfortunately.
Okay. Any other questions for Marek? Question down the front here, please. There's a couple down here, Chris. Start with you. Yes, please. Yeah.
Are you agnostic in terms of geographical location of the companies you invest in, or do you look for a particular split?
No, I don't look for a particular split. The thing is, this is one of the most global industries there are. So what tends to happen is, for example, if you're a European company, just for example, if the idea is really good and you tend to move to US. It's not like you can come a certain way in Europe, but if you're going to want to have better valuations, better financial climate, and it's much more evolved in the US, so you tend to move your headquarters to US. We have seen many of these companies. Many of them we are invested in have dual listings. They are listed in US and Europe. When it's come to China, we have invested or invest in companies that have a listing in the US. They are based in China but have listing in the US because the opaqueness of the political landscape, we really want to make sure that the accounting rules, everything is followed the same way as it is in the rest of the world. But I think 85% of our holdings are based in the US, but originally maybe 50.
Yes, please.
Thank you. You mentioned that discovery to revenue is about 10 years. Will AI help at all here to move things faster? What's the overall impact of AI in this industry?
That's a really, really good question. I think AI is a fantastic tool. I mean, it helps drug development in the early stages, it's fantastic because you can 3D make the receptors or whatever in 3D, and you can actually conduct stuff in silico instead of having mice, etc. But in the end, you can save a lot of time there, maybe limit failures, and I think that's good. You can save time there. The problem what occurs in pharma and biotech, you need to conduct human trials, phase 1, phase 2, phase 3, and that's a prerequisite. It's a demand from governments or FDA. It takes 5 years to conduct those, and I don't see any time soon that you can risk that, so to speak, at the moment. Maybe in the future.
Question towards the back, yeah?
Thank you. One clarification I seek is that you initially mentioned that your companies were innovative, early phase, but then you went on and later said that a lot of the companies already had drugs on the market. That seemed to be a contradiction. And following on, what's your exit strategy? So if a company's been successful in developing a drug and it's got the license, the IPR, etc., would you hold onto that until the license expires, or do you want to sell it off as quickly as possible? Thank you.
Really good question. I think the first question is really good. So what I mean by innovation is that, that these companies have drugs or develop drugs that will supersede what's on the market. So their innovation, I mean, the key here is like, we have been following these companies for maybe 5 years. So how we operate, for example, Vera, I would just take it as an example. We have known this company for 5 years. We invested in them 5 years ago. But maybe as a smaller portion to begin with, because early stage, high risk, and over time they kind of graduate into our top 10 once they've de-risked, but also shown that their science has proven in clinic. So that's how we view, but you have not seen like below that we have more innovation and maybe more companies. So I think between 60 and 80 companies in our portfolio. But the key is that early stage, we tend to have a smaller proportion and then they grow into that. So that's maybe an answer to, the second was, how long will we hold it? We look at the company of, they need to have the criteria, as I mentioned here, they need to have these criteria or the prerequisites. If an M&A comes around, fine. It's not a strategy for us to have an M&A. We look at the credentials in the company. The only thing M&A does, or an acquisition, is that it front loads the upside. It just front loads 2 years. When it comes to IP protection, every case is very nuanced. Some companies have other products, but what tends to happen is that the closer you are an IP expiry, the company becomes less and less valuable. It's like a football player that is 35 years old in Premier League. He probably will not sign a 5-year contract with that guy. So that's kind of how it works. It's kind of on the end stage, and it's often reflected in valuations.
Can I ask, what's your success rate for the multiple small companies at the bottom that you've had a relationship for many years that were truly innovative? How many of those fail?
Ooh, many fail. I would say this is a grueling job. 1,000 companies in our universe, approximately. As you can imagine, around 50 to 80 in portfolio. So 95% will not even be part of the inclusion. But if you think about industry statistic, once you move into phase 1 to market, it's 90% failure rate. This is why we also reduce our position going into these binary events. We don't want to explain to you why we lost 50% of our company's value, because we thought we were better and then we had a gut feeling it would work. It doesn't work like that. You have to be like a card counter. You just statistics. Be very disciplined.
Do you have any final questions for Marek? Question here, please. Thank you, Chris. That's for the last one.
Going back to your point about the correlation with interest rates, I presume startups or newer companies would have a significant amount of interest rate. What would interest rate roughly be as a percentage of cost for a new company or a startup?
The thing is, in biotech, you never borrow money. So you raise money. How it works, you have venture, like seed investments. Banks will never borrow money or loan money to a venture like biotech. So this is why the ecosystem works. You have venture that invest early on, and they kind of prune them into a maturity that is good enough to be put on the stock exchange or be acquired by pharma. So that's kind of the part that is not public. You don't see that. And once they're on the public stage, they can raise money on the open market. So this is how it works. But cost of money is cost of money. Even though you raise the money, cost of equity is probably even more expensive than interest rates. So I don't know exact the number, but to your point, it's much tougher for the early stage companies now than it was, I would say, 5 years ago when interest rate was 0. I personally don't think it's a bad thing. I think it's good because you kind of have a much more survival of the fittest way. You have the best companies surviving, and this is why I think productivity will increase over time.
That's terrific. Thank you very much indeed. Thank you for presenting tonight.